This week I'm going to show you the UK stocks that I bought, the top riser and faller in the portfolio, and as always the share tip of the week, which is a higher risk growth stock listed in the AIM markets. And if you find the video useful or enjoy the series, please drop me one of these to support it. According to Google Finance, the FTSE 100 is down by 0.4%, the FTSE 250 is actually up by 2.48%, and the S&P 500 is also up by 0.91%. My portfolio has done very well this week, increasing by 5.65%, meaning I have outperformed the markets this week. Although I'm not overly excited or anything, this is because the short-term volatility or movement/changes in share price doesn't matter to me. After all, I'm investing for potentially the rest of my life, and so the changes week to week aren't that important. What I do care for is that hopefully over the longer term, the performance in the portfolio becomes more consistent, less volatile, and therefore slowly and steadily generating impressive shareholder returns. Regardless, what this week has shown is that as I'm evening out the positions or balancing them out into weightings that I prefer, that it seems to be working out better for me and therefore reducing the overall volatility, but at the same time giving me better returns than I may have had. Although that could be argued with Softcap that have continued to rally. Just quickly, I'd also like to mention I've picked up the 1,000 companies from the London Stock Exchange Group, and I'd like to thank you to the viewer that had suggested this to me, and we'll be having a look at this later on. The three top topics of the week start with the YouTube channel. And actually that sounds like it makes me a lot more important than I really am. But I wanted to take this time slot to just tell you a brief update on what's happened over the last week. In case you didn't already know, my graphics card in my computer behind me had actually blew, and it basically had meant that my computer was unable to render or edit videos. Here you can see my graphics card with the massive cooler on the side of it. I'm guessing one of the capacitors had blown on it. This basically had meant that in desperation I had asked you in the community what I could do, and other than the overwhelming amount of support and love that you had shared to me, which I very much appreciate, both your kind words and suggestions, the general idea was that I should have done a live stream. So on Tuesday, I had actually live streamed a stock market Q&A, although there were many issues with it, partly due to the fact that the computer was used to live stream, and there were still some faults with it, including mainly the software of Windows. This had happened and there were a lot of faults, the audio bugged out, and eventually it resorted to me trying to talk but you couldn't hear me. I tried a second stream but eventually just gave up on the idea, and I am sorry that it has potentially notified you multiple times, but this should all have been solved now. I've bought, well, a new graphics card, technically a replacement should I say, and now going forward content should be back to 3 times a week. But I'd also like to say I'm not going to drop the idea of live streaming. I'd just like a little bit more time to prepare for it, and then perhaps we could have 3 videos a week and a weekly live stream. Now to the actual news of the week, and a company that I've closely followed but not bought into. This company is named Avon Rubber, and their shares since the start of the month have dropped by nearly 34%. This was an excellent performer in the year and had really generated a serious, is it multi-bag? I'm not sure, I don't quite know the term, but it had generated over 100% returns in the last year, although that's come crashing down. This is due to a delay in contracts, meaning that they would have to wait another year before they have these contracts from the US government. Obviously, this had spooked investors and therefore led to them selling out of the position, especially because 2 weeks ago there were further concerns with the business. And this was due to their recent acquisition, which had actually meant that the company's pre-tax profits were only £500,000 compared to the 8.7 million for the year up to 30th of September 2020. If you'd like me to talk more on Avon Rubber, I can do a stock analysis this week. And if you're interested in that, please leave a comment down below. The last item of news on the list is Boohoo, more specifically the chairman that rarely speaks out in public. He had held a, I believe, conference where he was answering questions. I've only seen the news articles commenting on it rather than the actual conference itself. But the idea is that he mentioned that Boohoo were committed to making things correct, going as far to say as making Leicester right, which is promising and hopefully a strong start to the business in their transitional period towards more sustainability or ESG, ethical, social and governance, meaning those funds could come back in the future, building up prices in the stock. Furthermore, Boohoo had exited 64 factories or supply chains in Leicester since late 2019, and this is combined with over 400 unannounced audits carried out this year. Although he wasn't willing to accept much responsibility on behalf of the issues in the company, going as far to say as there was no wrongdoing on Boohoo's behalf, and then furthermore that he was able, or the company would easily be able to adapt and move production overseas should there be continued flack from the media and the press that really impacts the business, and furthermore follow the rest of the companies in the fashion industry. I personally believe that as long as Boohoo remain committed to their policy for change and continue to spend more of their cash on these changes and transitions for the future, that at the moment, whilst they may be just a fair company at a wonderful price, hopefully 2-3 years down the line they could be a phenomenal company which is at a fair value. They were actually the top riser in the portfolio this week, and as in the last 5 days they had gained 7.89%. Although if we zoom out a little bit, we can also see that they've been trading sideways and have remained relatively flat since the start of the year. I strongly believe that with the pandemic ongoing and that it is far from truly over, that Boohoo are going to have a strong Christmas period combined with the recent Black Friday. I think Boohoo are really in for some impressive results in their trading update in January. Therefore, I still hold 2,500 shares and I will not be selling unless there are some serious issues with governance, which at the moment they still do not have an auditor, which has some concerns, although I'm hoping that this gets resolved in time. None of my stocks had actually fallen this week, which is a pleasant surprise to say the least, as the portfolio had been underperforming pretty consistently for the last few months. Meaning the Ashtead group was the top faller despite only falling, or rising in fact, by 1.52%. This is a company that I've wanted to top up a lot more, but just felt that I haven't had the right opportunity. There's that bias where you don't necessarily want to average into a company that's risen in share price, although I'm willing to do that. It's just I think there may be another transfer of wealth from the value recovery plays, which I think encompasses Ashtead Group, into the technology stocks that have been resilient during the pandemic. And in my beliefs, with the pandemic continuing, I think these technology stocks may see that money go back into them and see new all-time highs. At which point I think Ashtead Group may decrease with investor sentiment, and at which point I would like to buy up more shares and build up my position, as it's a company I very much like and they've shown extreme agility and resilience despite the ongoing pandemic. I continue to hold 45 shares and I have absolutely no plans to sell this position at all. This week I continued to trim my position with Softcap, starting the week with 50 shares, now down to only 20. I had sold 30 more shares as the share price had risen. I decided to take profits as this is a very cyclical stock and they seem to get a lot of momentum, but I'm happy to miss out on more potential gains as I'm reinvesting that money into other positions in the portfolio to really build up equity in stocks I understand. The idea is then that once eventually, and likely next week, once this position is completely gone, I will then have only 5 stocks to focus on and I can put more attention and research into them, building up equity in them, remaining confident, and then in the future as my wealth builds, I could potentially diversify further, but then still retain that knowledge from these stocks. So that hopefully there's also more balanced diversification, which reduces the systematic risk, i.e. from Boohoo being much higher of a proportion, meaning that previously in the year they had 50% of the portfolio, meaning they would massively impact my volatility, whereas in the future hopefully it would be more balanced between each of my holdings, therefore giving me a little bit of an equilibrium, which is a bit far-fetched, especially in the stock market, but ideally more balanced, consistent long-term returns, and then a more stable portfolio for the future. And then hopefully this will allow me to catch back up to the FTSE 250, in which I believe I'm trailing by around 6%, and then ideally get ahead of the S&P 500, which I'm likely trailing by around 15%. Although this is heavily tied to Boohoo and who really knows what will happen with this stock in the next year. I bought 2 more stocks this week, starting with Halva, and I'm going to continue buying this stock. They've been quite boring lately, and I actually see an opportunity present. This is because their mergers and acquisitions activity has been pretty quiet, and this is a company that usually makes fairly regular M&A activity. This could mean that as the pandemic starts to ease off, they may start to acquire or merge with businesses that are likely struggling, and then they can use their size, scope and scale to develop them, make them much more profitable and give them another stream for growth. Therefore, I'm happy to continue buying into this stock, even if the share price rises somewhat, as I think over the longer term, I could certainly build more value. In fact, I think Halva are actually the business which are the strongest placed in my entire portfolio, and I think that as they continue to grow in size, that they will still be able to generate steady, consistent growth on revenue and earnings, and also that dividend, which I believe is very near to that 40-year mark of dividend growth. It may be more, it may be less. My position size with Halva is 36 shares, meaning in the last week I've bought 3 more shares. Although this position is heavily underweight, and I'm hoping that I can push more equity into it over the next 6-month period, and it could be a much more staple part of the portfolio. And I'm likely going to continue topping up, as over the long term I can see a lot of value in this business. And if you sign up to Trading 212 using my link or promo code, then you can get a share worth up to £100 when you deposit just £1 using either my link in the description down below or that promo code at the bottom left of the video. The other stock I had continued to buy is Games Workshop, and this is likely a month streak of purchasing this stock. That's because I think they were unaccurately represented by the market and therefore were deemed to be fairly undervalued in my personal opinion. Sentiment is starting to recover now and shares are peaking £108, and I've been buying at less than the £100 mark, which has already meant that I've been getting some significant gains in this regard. I think they had a massive overreaction, they've had truly surplus cash and very impressive pre-tax profits, and yet the shares were decreasing at that moment in time. They have truly incredible amounts of surplus cash, which accounts for their newer business emergency fund, which I don't see too many companies doing, and this makes them a much higher quality in my personal opinion. I think that in the short term I may not be purchasing that much more shares of Games Workshop, simply because it seems that sentiment seems to be rising and recovering back to where it was, and therefore I can put my focus elsewhere into the portfolio. But over the longer term I would definitely like to keep this a big position in the portfolio, and will build upon it on every weakness. I've bought 4 more shares of GAW, bringing my total position size to 50 shares, or an equity of £5,400. The share tip of the week is a higher risk growth stock listed in the alternate investment market, or AIM. Although their risk is not because of their business model, but rather just the market itself. They have low liquidity, meaning that the share price can be quite erratic or volatile. This means that you may be placing an order through, and the price, despite saying it might be £8 per share, in reality you may be buying for slightly more or slightly less. This could be a threat to those that you're trying to cash out at certain times and there isn't enough liquidity to fill the order book, and therefore there is that risk there. I believe they are in a sector with long-term growth potential and it looks really promising. And recently we've seen a bidding war for one of their competitors, and this had really sparked up some enthusiasm with the other stocks in the sector, which have seen quite a significant rally across the board. Although this company themselves hasn't really seen that. Whilst they're a strong business and provide long-term investment value and have the factors that I like to look for in a business, there's also that opportunity where a business, a larger US business, could acquire them for a higher valuation, therefore giving you a significant shareholder return. They have a fantastic balance sheet with 0 debt and a mountingly high cash position, combined with truly incredible revenue growth and also very high profit margins. In the last 5 years, they've managed to grow their earnings by 44.9% on average each year, and in the last year returned shareholders with 131.5% without dividends. This company is called Team 17 and they own some very popular franchises under the names of Worms, the Overcooked series, and also The Escapist, but they also act as an independent developer for other firms. And as I said, whilst the industry has seen broad increases across the board due to the Codemasters acquisition or bidding war by both Take-Two and also EA, Team 17 haven't quite seen that, and therefore I think there is an opportunity present, and I think the market has overlooked them. If you're interested in my Diageo stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a great weekend.